good day.
Welcome to this week's Financial Flash, number 300. The Federal Reserve governors met on Wednesday this week. While they held the Fed funds rate steady, the lack of guidance for further action created a volatile day for the markets. Let's break the situation down a little further with a rational lens to consider what happened. The Federal Reserve voted yesterday to leave the federal funds rate unchanged at a target range of 3.5% to 3.75%. It was the fifth consecutive meeting without a change, but the decision was not unanimous. The vote was 9-3, with 3 members favoring a quarter-point increase. Chair Kevin Warsh was emphatic that the Fed's 2% inflation target is non-negotiable. He said the recent improvement in one monthly inflation report played only a small role in the decision. The Fed is looking for a sustained trend rather than reacting to a single data point. Warsh also made clear that holding rates steady should not be interpreted as the beginning of an extended pause. If underlying inflation continues to rise while the labor market remains stable, another rate increase remains possible. At Stiles Financial Services, we believe the continued economic growth generated by the ongoing artificial intelligence infrastructure buildout is contributing to inflation. Massive investments in data centers, semiconductors, power generation, electrical transmission, cooling systems, and networking equipment are supporting economic growth and employment. At the same time, the spending is increasing demand for energy, skilled labor, construction materials, computer components, and capital. AI investment could eventually improve productivity and expand the economy's capacity, but during the build-out phase, it is also creating near-term inflationary pressure. That makes the Fed's job more complicated. Warsh provided very little guidance about what the Fed might do in September. This reflects a deliberate change in communication strategy. He wants markets responding directly to economic data rather than relying on Fed forecasts, speeches, or hints about the next policy decision. Warsh also argued that financial conditions have already tightened, even though the Fed did not raise its overnight rate. Both nominal and inflation-adjusted Treasury yields have risen substantially since the previous meeting. In his view, the bond market has already done some of the tightening that otherwise might have required action from the Fed. Markets were not entirely comfortable with that explanation. Short-term yields declined after the announcement, while longer-term yields increased. The 30-year Treasury yield moved above 5.2%, its highest level since 2007. This steepening of the yield curve suggests investors became less certain about an immediate rate increase, but more concerned about longer-term inflation, government borrowing costs, and the credibility of the Fed's inflation commitment. For the stock market, the decision creates a mixed environment. Holding short-term rates steady avoids an immediate increase in financing costs. However, higher long-term yields increase borrowing costs and the discount rate applied to future corporate earnings. That can pressure valuations, particularly for highly valued growth companies whose expected profits are concentrated farther into the future. Banks and other financial companies may benefit from a steeper yield curve, while highly indebted companies may face refinancing pressure. High-quality bonds are offering more attractive income, although rising yields can create additional short-term price volatility for longer duration securities. At Stiles Financial Services, we do not believe successful investing depends upon correctly predicting every quarter-point move by the Federal Reserve. Monetary policy matters, but it is only one part of a larger investment environment that includes corporate earnings, valuations, economic growth, and each client's individual financial objectives. Our disciplined approach begins with the client's financial plan. We construct portfolios intended to provide the growth, income, liquidity, and risk characteristics needed to support that plan. We then make adjustments intentionally, not simply because markets react sharply to a press conference. In this environment, discipline means maintaining diversification, emphasizing financial quality, managing interest rate exposure carefully, and ensuring clients have appropriate liquidity. It also means rebalancing when market movements create meaningful opportunities. The central message is that interest rates may remain elevated and volatile for longer than investors previously expected. Another rate increase is possible, but it is not predetermined. For long-term investors, that uncertainty is not a reason to abandon the plan. It is a reason to remain diversified, maintain patience, and continue making investment decisions with discipline and intention. Thank you for tuning in, and make sure you catch us next week for a new topic on the Financial Flash Report.
Educational content by the professionals at Stiles Financial Services, delivering customized portfolios aligned to your unique wealth goals.